Hello, everyone. Welcome back to another episode of Unbox Your Curiosity. I am your host, Christiane Zhao. Today, let's dive into a topic that is hot in payments, stablecoins. Imagine this. You're checking out online, maybe, picking up groceries or ordering that new gadget, and instead of clicking credit card or digital wallet, you pay with a stablecoin. Sounds pretty out there, right? Well, it might actually be far closer than you think, especially with household names like Amazon and Walmart actively exploring the space. So let's embark on a deep dive into the fascinating and sometimes, quite complex world of stablecoins. We've pulled together a rich stack of sources that truly reveal how these digital assets are no longer just a crypto curiosity. They're becoming a legitimate, powerful force that's starting to reshape how we think about money and, well, how we actually make payments. As usual, I have generated an AI guest, Steven, with me. He is a Google Gemini-powered model that is built on 30 sources I found on stablecoins. I hope this short 20 minutes podcast can give you a rough overview about it.
It's genuinely striking, isn't it, just how rapid the evolution of stablecoins has been. They've moved from the very edge of the crypto ecosystem, sort of the fringes, directly into strategic discussions. We're talking boardrooms of major financial institutions and global retail giants. Our mission today is really to unpack exactly what stablecoins are, explore their maybe surprising real-world applications, weigh the significant opportunities against the complex challenges they present, and ultimately understand their profound implications for our traditional payment systems.
Okay, so to kick us off, what exactly is a stablecoin? I mean, you hear crypto and you often think wild price swings, right? But stablecoins are fundamentally designed to, defy that they're a type of cryptocurrency that's pegged usually to another asset, typically a stable fiat currency like the US dollar. The whole idea is just to maintain a consistent value so you don't wake up one morning to find your digital dollar is suddenly worth like half as much. To keep it simple, a stablecoin is a cryptocurrency designed to minimize price volatility by being pegged to a stable asset like a fiat currency or a commodity.
Exactly. Stability is the key word there.
And what really caught my eye on our research was just the sheer scale of their ascent. The market for these assets has absolutely exploded. We're talking about a leap from a, pretty modest $5 billion market cap back in 2020 to projections of over $200 billion by 2025. And within that massive number, just to tether, that's USDT and USD coin. USDC actually account for over 90% of that total market. It's quite concentrated.
It really is.
But it's not just about the market cap value. Here's the part that really blew my mind. In 2024, stablecoins process an astonishing $27.6 trillion in annual transaction volume. To put that in perspective, for you listening, that actually surpassed the combined volume of Visa and MasterCard.
That single fact, the transaction volume, it's a seismic indicator, isn't it? It tells us that stablecoins aren't just some interesting alternative anymore. They're already a dominant force in some ways, fundamentally challenging the long-held supremacy of traditional payment networks. This kind of growth signals a massive shift in how value is being transferred globally. It highlights an increasing demand for instant, cost-effective payment instruments. And our sources, including one specifically titled "Americans Will Put Money in Amazon and Walmart Stablecoins," even point to the Genius Act.
Right, the Guidance on Evolving Networks for Increased Utilization of Stablecoins Act.
We have a mouthful. Yeah, it is. But it's seen as providing a key blueprint, essentially, for how banks, and by extension, these massive retail entities like Amazon and Walmart, can operate within a new regulated stablecoin framework. And that really leads us to the core question, why? What's making these massive retailers and financial institutions so eager to jump into stablecoins? Well, one of the biggest drivers, as you might guess, is the potential to drastically reduce transaction costs. Consider this. Globally, roughly $7 trillion is spent annually just on transaction verification fees. That includes those, pesky credit card and wiring fees.
$7 trillion.
Yeah. Stablecoins offer a way to cut this down significantly, avoiding, for instance, the typical, say, 3.5% credit card fees. From a business perspective, it's often perceived as sorely overdue.
And this isn't just theoretical savings, right? Stablecoins are finding real tangible traction in key areas, like cross-border payments, for example. The traditional system there can be notoriously slow, expensive, often opaque. It relies on these complex networks of correspondent banks and high fees that really eat into remittances and business profits. Absolutely a major pain point.
But stablecoins. They offer a remarkably faster and more cost-effective alternative. Think about B2B transactions, remittances. They streamline the whole process by dramatically reducing the reliance on intermediaries. And that, in turn, cuts down fees and speeds up settlement times significantly. They can even carry more detailed payment data, like invoice references, which boosts transparency. What's particularly impactful here, I think, is how they're transforming markets where maybe efficient financial infrastructure is limited. It allows seamless transfers without needing traditional brick-and-mortar banks. It's not just speed, it's a potentially powerful tool for financial inclusion globally. Exactly right. And we're seeing major players not just dipping their toes in, but like fully entering the arena. Companies like Visa, MasterCard, PayPal, they're actively integrating stablecoin technology into their offerings. JP Morgan, for instance, has launched JPMD. That's a digital deposit token for its institutional clients running on Coinbase's Base blockchain. It's designed specifically for on-chain settlements and cross-border B2B transfers. And importantly, it's fully insured and interest-bearing, so it's kind of blending that digital innovation with traditional banking strength.
So basically, stablecoin is bridging the old and new worlds.
Precisely. And even payment processors like Stripe, they're charging significantly lower fees for stablecoin transactions. We're like just 0.1% to 0.25% compared to traditional card payments. That's a huge difference. And we've seen PayPal make its first B2B transaction in PYUSD, their own stablecoin. Circle is actively promoting USDC in places like Brazil and Mexico, connecting it to local real-time payment networks. The very idea of stablecoin payment cards is gaining ground too, projected to reach, $2.73 billion by 2033? It's truly bridging digital assets with real-world spending.
And it's not just payments, is it? There's the whole DeFi angle too.
Oh, absolutely. Beyond just payments, stablecoins are heavily used in decentralized finance, or DeFi. Things like liquidity provision, yield farming. Users can deposit stablecoins to earn interest or mining rewards, sometimes with annualized returns that can, in certain cases, even surpass traditional bank deposit rates. And from a user perspective, some have also found the, let's say, perceived privacy when salaries are paid in stablecoins to be an attractive aspect. Though it's important to note, our sources also frame this as a user perception of a novel advantage in what's still a rapidly evolving regulatory space.
Okay, it certainly paints a very compelling picture, efficiency, inclusion, lower costs. But like with any major innovation, especially in finance, there's always another side to the coin, right? There are risks, there's pushback. What's the biggest skepticism or concern you're seeing when people talk about stable coins, even with all these benefits?
That's a crucial question, because the risks are significant.
Yeah, one of the biggest eye-openers for me, actually, when digging into this was learning how similar payment stablecoins can be to money market funds, particularly when it comes to the risk of runs. If you remember the financial crisis back in 2008, or even the start of the COVID-19 pandemic, those money market funds saw huge outflows very quickly. Stablecoins can face similar vulnerabilities, especially the ones issued by non-banks. The fear of not being repaid can trigger a cascade. Early redeemers get out may be okay, but those who remain face much higher risks of loss.
That's a crucial point. The run risk is very real. And our sources highlight several critical areas of concern around stablecoins. First, there's what you might call reserve transparency and liquidity risk. Think back to May 2022. Tether, USDT, the biggest stablecoin, briefly lost its peg to the dollar. It dropped to about 94 cents. That event led to massive investor withdrawals and really shone a spotlight on concerns about the liquidity and the actual composition of its reserves. Users often voice skepticism. Do issuers really have enough liquid assets for full on-demand redemption, especially under market stress?
Right. Can you actually get your dollar back when you need it?
Exactly. Then there's the risk of mismanagement of reserves, or third-party risk. A really notable example was when USDC briefly depegged after its exposure to Silicon Valley Bank came out. That showed how problems with the traditional banks holding the reserves can create contagion risks that just ripple through the entire crypto ecosystem. Our sources indicate that choosing reliable, stable partners remains a huge challenge for stablecoin operators.
And what about the tech itself?
Good point. We also need to consider technical vulnerabilities, particularly in the smart contracts that govern how these stablecoins operate. Bugs or errors in the code, They could be exploited by malicious actors. That could lead to price manipulation, or worse, outright theft of assets. It's an ongoing concern for users who, frankly, might worry about how reliable the audits or reviews of these incredibly complex codes really are.
It sounds like there are different flavors of risk depending on the stablecoin type, too.
Definitely. Beyond those general risks, there are specific ones depending on the design. Fiat-backed stablecoins like USDC or USDT, they face centralization risks because they rely heavily on centralized companies and traditional bank accounts. Crypto-backed stablecoins, they raise concerns about their reliance on automated smart contract management, and of course the risk that their collateral could suddenly devalue if the underlying crypto assets drop significantly in price. And then there are the algorithmic stablecoins. These famously lack physical collateral altogether and depend on really complex economic models to maintain their pegs. They generally have a high entry barrier, operate in a relatively immature ecosystem, and we all saw how that can go wrong with the dramatic collapse of Terra USD or UST. Yeah, that was a big one. Huge. And these challenges, they extend deeply into cross-border use as well. You mentioned the benefits earlier, but inconsistent access to on and off ramps, that's basically where you convert stablecoins to and from traditional currency that can create serious bottlenecks, especially in places where digital payments aren't widely accepted yet, or where you still need physical agent networks. And having all the different entities involved in a stablecoin arrangement spread across different countries, well, that introduces coordination issues, which inevitably affects the speed and the costs. So the promise is there, but the practicalities, they're still being worked out.
Okay, so we've explored how these private stablecoins are rapidly challenging the existing payment landscape, but they're certainly not the only new player on the block, are they? Their rise has actually spurred a really significant government-backed counter-movement, Central Bank Digital Currencies, or CBDCs. How do these fit into this evolving picture of money? How are they different?
That's the next big piece of the puzzle.
You can sort of think of a CBDC as a digital representation of a country's physical cash, like a digital dollar or digital euro, but issued and regulated directly by the central bank itself. So unlike privately issued stablecoins, CBDCs are directly backed by that central authority. They carry the same risk-free characteristic in theory as physical cash. What really stands out to you about that fundamental difference?
Well, it's a critical distinction, isn't it? And it brings us to a really compelling question. Why are central banks all over the world suddenly racing to develop their own digital currencies? As of 2025, get this, 134 countries, representing a staggering 98% of global GDP, are either actively researching or actually testing CBDC.
98%? Then it is almost everyone?
Pretty much. Countries like the Bahamas, Nigeria, Jamaica, they've even fully launched them already. The motivations are pretty clear when you look into it. Central banks want to preserve monetary sovereignty, first off. They also want to enhance financial inclusion for their citizens, reduce reliance on existing private payment networks maybe dominated by foreign companies, and strengthen overall financial system transparency.
So maintaining control and improving the system.
Essentially, yes. For instance, the European Central Bank sees the digital euro partly as a way to counterbalance the dominance of US dollar-backed stablecoins and, safeguard European financial autonomy. In the UK, the thinking is that a digital pound is likely needed by 2030, with a big focus on retail use, but also ensuring continued access to physical cash alongside it. Now, these CBDCs are generally being designed with some specific features. They won't be anonymous, generally. Central banks or governments won't have direct access to your personal data. That data would typically be anonymized and handled by private intermediaries. And crucially, they typically won't pay interest. That's deliberate, to avoid them replacing commercial bank savings accounts, which could destabilize the banking system.
Interesting. So they don't want everyone pulling their money out of banks. What about limits?
Exactly. Holding limits are also being seriously considered, like maybe around €3,000 for the digital euro, or perhaps 10,000 to 20,000 pounds for the digital pound. Again, the idea is to prevent large, rapid outflows from commercial banks that could impact financial stability. And here's something really fascinating. While the digital euro and pound are specifically not intended to be programmable money, meaning the issuer, the central bank, can't control how you spend it.
Oh, okay, that's a common fear.
Right. But they do endorse the idea of programmable payments, which means you, as the consumer, can set conditions. You could authorize your bank or payment provider through private sector interfaces to make automatic payments, say when goods are delivered or a service contract is fulfilled.
Got it. So user-controlled automation, not issuer control.
Precisely. That distinction is key.
So it's clear that both stablecoins and CBDCs represent this huge new frontier in finance, and regulatory clarity seems absolutely paramount for their success and safety. We mentioned the US formally enacted the Genius Act in June 2025 that established a comprehensive federal framework for stablecoin issuance and custody mandates, things like 100% reserve backing, regular audits, licensed operations. It's a formal recognition of their financial significance.
Big step, yeah.
And across the pond, Europe's MiC, a framework that's the Markets and Crypto Assets Regulation, has introduced similarly stringent requirements for transparency, reserve backing, and consumer protection for stable coins. So for traditional banks, getting involved with stable coins means navigating these really complex regulatory waters. They have to address heightened risks, credit risk, market risk, liquidity risk, operational concerns. They face expectations around capital treatment, like the Basel Committee's differentiated framework, the international body setting banking standards, even if it's not fully implemented everywhere yet. And of course, robust liquidity management. What really stands out to you about how traditional finance is grappling with these new digital assets? They often seem to move at a much slower pace in the tech world.
Well, that's a key observation, isn't it? The core question for traditional finance is how do you integrate these powerful innovations safely and efficiently without disrupting the existing stability that people rely on? In the long-term outlook, it probably isn't about one form of digital money winning. It seems much more likely to be about coexistence. We're looking at a future where regulated stablecoins, CBDCs, and yes, enhanced traditional payment systems will all interact. Interoperability between these diverse systems is going to be absolutely crucial. We need to avoid fragmenting the system and ensure truly seamless value transfer for users, wherever they are.
So different tools for different jobs, potentially.
Exactly. The market is indeed expected to segment somewhat. You'll likely see regulated stablecoins like USDC and PayPal's PYUSD poised for broad institutional adoption. They can serve as that critical, stable bridge between traditional finance and the burgeoning digital asset economy. And while emerging markets and developing economies might stand to gain the most from stablecoins, given their existing payment frictions, they also face proportionally greater risks, things like currency substitution, where people ditch the local currency, or volatile capital flows, if these systems aren't managed very carefully by their respective governments.
So here we are then standing on the edge of what really feels like a truly new era in finance. Stable coins championed by tech giants like Amazon and Walmart, and increasingly embraced by global financial institutions. They are undeniably a game changer. They offer this promise of faster, cheaper, and more transparent payments, pushing innovation across the globe in ways we're probably only just beginning to fully understand. The regulatory landscape is rapidly adapting. You can see governments getting very serious about this technology. They're aiming to harness its potential, while of course trying diligently to mitigate those inherent risks we talked about. The vision is becoming clearer, I think, to maintain financial leadership, foster an interconnected global economy where digital money plays a central and likely ever-growing role.
And if we connect all these threads, pull back to the bigger picture, it really suggests that money as we fundamentally know it, is undergoing a profound evolution. We seem to be moving toward a future where multiple forms of digital value, from central bank-backed digital cash, the CBDCs, to privately issued but meticulously regulated stablecoins, will likely coexist. They'll compete, maybe even complement each other, within a much more diversified financial ecosystem. And this really raises an important question for all of us, for you listening, the end users. In this increasingly digital and dynamic world, what will you choose as your preferred method for sending, receiving, and storing value? It's something we'll all need to consider.
Thanks for staying with me through this episode. If you found this thought-provoking, make sure to follow Unbox Your Curiosity on Spotify, Apple Podcasts, or YouTube. And of course, feel free to follow me on LinkedIn. I'd love to hear your thoughts. Until next time, stay curious and stay real.